Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Carlisle Companies Incorporated, CSL. We've been tracking CSL's deep transformation for a while now, watching them successfully divest those non-core assets to become a true pure-play building products powerhouse.
A real focus company, yeah.
But, a long-term strategic pivot doesn't exempt you from short-term economic realities.
Not at all.
Especially when those realities involve softening construction markets. So what we're doing today is a meticulous examination of their recent Q3 2025 performance to really stress test their strategic shift against some very real, very persistent economic headwinds.
And that stress test, it reveals the absolute core conflict defining the CSL investment case right now.
Okay.
Carlisle's making a definitive bet. It's that its bold Vision 2030 strategy, and we're talking targeting over $40 in Adjusted EPS and an impressive 25% plus Adjusted EBITDA Margin.
Huge numbers.
Huge numbers. That this strategy, coupled with an aggressive $1.3 billion share buyback program, will successfully accelerate future growth and overcome the persistent pressures of soft construction markets.
But there's a but.
There is. However, these immediate headwinds are specifically evidenced by the recent 2.1% organic revenue decline in the third quarter of 2025. And on top of that, the resulting 170 to 190 basis points of margin compression you can see right across the consolidated business.
That is a phenomenal setup. You have this high-flying, future-focused vision. $40 EPS is a number that grabs your attention.
It really does.
But it's being dragged down by the concrete realities of today, which are declining organic sales and pretty punishing margin compression.
Yeah.
So our mission today is really an investigation into whether CSL's internal growth engine, the financial engineering and the future innovation, can truly build a strong enough bridge to offset these very tangible current market challenges that are hitting the entire global construction sector. We have to start by grounding ourselves in the recent Q3 financial statement. We need to understand the immediate effects of this market softness. What did the quarter actually look like on the balance sheet?
Okay, so if we look at the results for the period ending September 30, 2025, the consolidated picture, it appears stable on the surface.
On the surface.
But it immediately raises some red flags once you look a little closer. Total revenue came in at $1.347 billion.
Okay.
Now, this represented a slight year-over-year increase of exactly 1.0%.
So, growth.
Well, typically, even marginal revenue growth is positive news, but the moment you move to the bottom line, the picture darkens substantially. Adjusted EPS was $5.61, which unfortunately marked a 3% decline compared to the prior year period.
And that is the essential tell. Revenue marginally up, EPS down. For anyone new to this, that doesn't just happen randomly.
Oh.
It screams that the cost structure is under enormous pressure, likely because fixed costs are just overwhelming shrinking sales volumes.
It's the classic sign of volume deleverage at play, and it absolutely undermined the quarter. That 1.0% revenue increase was entirely artificial in terms of the underlying business health.
Artificial how?
It was driven exclusively by accretive acquisitions. Management confirmed a sharp 2.1% organic revenue decline in the quarter. And when volume drops like that, the concept of volume deleverage becomes lethal to profitability.
Let's just pause on volume deleverage for a second because it's a technical term, but it is absolutely central to understanding CSL's short-term struggle.
It is.
What does that specifically mean for a company like Carlisle? They operate massive manufacturing facilities for things like roofing materials and weatherproofing systems.
It means every single unit they sell suddenly costs more to produce, even if the raw material price stays the same.
Right.
Think about their operations. They have these vast factory floors, expensive machinery, salaried plant managers, security, utility costs. All of these are fixed operating costs. They do not decrease when they sell fewer 12-foot insulation panels or fewer rolls of roofing membrane.
So the costs stay the same, but the sales drop.
Exactly. If production volume drops by, say, 5%, but the factory rent stays the same, that rent must now be absorbed by 5% fewer units. And that dramatically increases the cost of goods sold per unit. This is the phenomenon that is compressing CSL's profitability, regardless of their, excellent pricing power in prior periods.
So how punishing was this volume deleverage on their operational margins across the whole business?
The pain was significant and it was immediate. The consolidated Adjusted EBITDA Margin for Q3 was 25.9%.
Which is still a very healthy margin for the industry.
Oh, it is. But it represents a substantial drop of 170 basis points compared to the prior year. And if you isolate the gross margin, which is that immediate reflection of product cost versus sales price,
Yeah.
it dropped even more significantly. We're talking 260 basis points, landing at 36.0% in Q3 2025. That fall was directly attributed to those increased unit costs from fixed cost absorption on lower volumes.
Yeah.
It's just very hard to sustain pricing traction when the market is retreating.
And that combination is a direct substantial hit to profitability.
It is.
Okay, so given that they are facing a 170 basis point margin contraction, which is difficult to swallow, we still need to assess their financial foundation. Are they in a position of strength to weather this storm, or is this decline actually threatening their liquidity?
Their foundation is rock solid. And this, I think, is the crucial element that separates CSL from weaker competitors.
Okay.
While short-term profitability was definitely compressed, their financial discipline and their cash generation model remain incredibly robust. Year-to-date through Q3 2025, the company reported a massive $620.3 million in free cash flow from continuing operations.
That free cash flow figure is outstanding, especially in this kind of environment.
It really is.
It speaks volumes about the quality of their working capital management and collections.
It does. Management is extremely confident. They're projecting they're on track to exceed their Vision 2030 target of a 15% plus free cash flow margin for the full year.
Which is a very sticky, difficult target to hit.
Incredibly difficult. And hitting it during a downturn just underscores the resiliency they've built into their operational model. In fact, their full-year guidance is based on generating approximately $1 billion of cash flow from operating activities for the year.
$1 billion.
And this exceptional cash generation is the fuel for every single strategic initiative we're about to discuss. The R&D, the M&A, and that aggressive share buyback.
So they have ironclad cash flow, but they are also pragmatic. They acknowledge the persistent market softness by adjusting their forward guidance. What did that revision look like?
It was a conservative and a necessary adjustment. Acknowledging that the construction market's recessionary pressures are not lifting quickly, they adjusted their full-year revenue outlook to flat full-year revenue guidance.
Down from what?
Down from their earlier projection of low single-digit growth. This confirms that management is not banking on some miraculous market recovery in Q4. They are tightening their belts and relying entirely on internal execution.
That sets the stage perfectly. Strong cash flow, but organic revenues are flat or declining, leading to margin pressure.
Right.
So now let's break down where the actual pain and resilience are coming from within the two segments. Carlisle Construction Materials, or CCM, and Carlisle Weatherproofing Technologies, CWT. We need to understand the architectural defense mechanisms CSL has built into its business.
This segmented analysis is probably the most important part of the deep dive because it reveals where CSL's competitive moat truly lies. Let's start with CCM.
Okay.
It's the historical core of Carlisle, and it represents their most reliable source of earnings. The segment's foundation is the incredibly resilient re-roofing market.
Right. The re-roofing cycle is often cited as the great stabilizer for building products companies. Why is it so immune to general economic cycles?
Because it is fundamentally non-discretionary maintenance.
You just have to do it.
You have to do it. We often talk about the 20 to 30-year life cycle of commercial roofs. If you own an office building, a warehouse, or a shopping center, and the roof starts failing, you cannot defer that expense for 2 or 3 years waiting for interest rates to drop.
The water damage would be catastrophic.
A certainty. And the cost of remediation vastly outweighs the cost of replacement. This replacement and repair market, it accounts for a massive 70% of the CCM business.
Yes, 70%.
And this predictability acts like a defensive shield against broad recessionary forces because roofs wear out regardless of the Fed rate.
And did that defensive shield hold up in Q3 against this macroeconomic backdrop?
It performed exactly as you would expect.
Yeah.
Q3 CCM revenue was $1,000.8 million, which was essentially flat growth of 0.3% year over year.
So basically flat.
Basically flat. And this top-line performance confirms that the stable recurring re-roofing activity successfully offset lower new construction activity. New construction, which is highly cyclical and interest rate sensitive, was clearly retreating.
But CCM didn't notice.
It didn't notice, thanks to its re-roofing backbone.
But even with that stable volume from re-roofing, we still saw margin compression within CCM. So if volume held, what were the specific cost factors that were eroding that high-margin business?
This is where we see the dual pressures.
Yeah.
External costs and internal investment. CCM's adjusted EBITDA margin still declined to 30.2%. That's down 260 basis points year over year.
That's a big drop.
It is. Management was very transparent about the drivers, which were substantial and multifaceted. First, they faced $12.6 million in materials inflation. While prices softened overall, certain input costs remained sticky or were still flowing through inventory.
Okay.
Second, they incurred $13.3 million in higher operating costs related specifically to business enhancement initiatives like the Carlisle experience.
Wait, $13.3 million in costs related to the Carlisle experience? That sounds a bit vague. Are these efficiency investments or marketing costs? We need to know what they are spending $13 million on.
It's a mix, but it's primarily focused on structuring the company for long-term growth and efficiency, which often means short-term investment pain.
I see.
The Carlisle experience is management's internal term for improving the entire customer journey and digital interface, along with optimizing logistics and manufacturing flow. It's an investment in software, systems, and efficiency experts, structural costs designed to eventually reduce friction and increase velocity.
But right now, they are sitting as higher operating expenses, hitting the current margin.
Precisely. And finally, they saw an increase of $3.3 million in R&D expense, a direct investment that hits the P&L immediately, but is absolutely foundational to Vision 2030.
That makes sense. They are absorbing costs now for future gains. Now let's pivot to the vulnerable segment. Carlisle Weatherproofing Technologies, or CWT.
Right.
This is where the true market pain must be visible, as it lacks that re-roofing moat, correct?
Absolutely correct. CWT is the canary in the coal mine for the broader construction market. It
Yeah.
focuses heavily on both commercial envelopes and residential applications. Think air barriers, vapor barriers, and insulation for new builds.
So much more cyclical.
Far more sensitive to macroeconomic weakness. Specifically, the double whammy of high interest rates making new commercial projects more expensive, and the residential construction market slowdown driven by affordability issues.
And what was the organic volume performance here?
CWT experienced a much steeper, more painful 8.4% organic decline in Q3.
Wow.
It's a severe contraction, almost 4 times the rate of the consolidated business, and it directly underscores the disparity between the highly cyclical new construction market and that resilient re-roofing market.
An 8.4% organic decline in Q3 is a major stressor. That volume drop must have led to brutal volume deleverage in their CWT factories. What did their margins look like?
Brutal is the right word. The Q3 Adjusted EBITDA Margin for CWT was only 17.4%, which was down a stunning 330 basis points year over year. This segment clearly reflected the deepest pain, where those fixed costs just overwhelmed the shrinking volume base. This level of decline is what CSL is desperately trying to engineer a way out of.
Now, management stated confidence that CWT margins will stabilize around the 20% mark in Q4.
They did.
Given the 8.4% volume drop in Q3, I find that 20% stabilization target incredibly optimistic. Is that target based on any projected market rebound, or is it purely reliant on operational self-help?
It is entirely based on self-help, and you are right to be skeptical. They are explicitly not waiting for a market rebound.
So it's all internal.
All internal. Their confidence stems from the realization of hard synergies from recent acquisitions, like the integration of Plastifab, Thermofoam, and Bonded Logic, combined with accelerated investments in factory automation aimed at immediate cost reduction.
So they're trying to control what they can control.
Exactly. The goal is to control the cost structure so tightly that they can achieve margin expansion even if volumes remain depressed or flat. It's a battle of operational efficiency versus macroeconomic reality.
Okay, that brings us to the core thesis of this investigation. If the current market is soft and organic growth is challenging, CSL's investment case has to rest heavily on the confidence that Vision 2030 will deliver outsized growth when the cycle turns.
Yes.
So let's look at that future growth engine, innovation and M&A.
Vision 2030 is the structural engine designed to hit those headline goals. $40 plus adjusted EPS by 2030 and maintaining return on invested capital above 25%. And to achieve this kind of step change growth, CSL is deploying its cash flow into R&D and M&A aggressively. They're trying to transform their competitive moat from just a stable roofing supplier into an innovative construction solutions provider.
Let's start with R&D. The numbers cited, a 5-fold increase in spending, are just staggering for a traditional industrial company. What is the goal of raising R&D spending to 3% of sales by 2030?
For a company of CSL's maturity, raising R&D by 5 times is essentially restarting its culture of innovation. It signals a shift from incremental product improvements to disruptive solutions. The objective is strategic. Generate 25% of revenues from new products introduced within the past 5 years. If they hit that, they become a high-growth industrial stock rather than a cyclical materials supplier. This high R&D commitment is designed to yield quantifiable value for the contractor, which in turn justifies a pricing premium, the ultimate competitive moat.
And we know exactly what problem they are trying to solve. The chronic, expensive construction labor shortage.
The number one problem.
Tell us how their R&D is specifically focused on saving labor.
This focus is brilliant because it addresses the number one structural constraint facing the industry globally. Contractors aren't short on demand, they are short on skilled labor.
Yep.
So CSL is introducing products that radically reduce man-hours on the job site. Take, for example, the Blueskin VP Tech system. This product combines what used to be multiple components, primer, sticky membranes, fasteners into one integrated, easier-to-apply weather barrier system.
So fewer steps.
Many fewer steps. Installation trials documented that this system cuts installation time by a massive 30%.
A 30% reduction in installation time. That is a huge economic incentive for a general contractor. If labor costs $100 an hour, saving 30 minutes on every hour of installation is a game changer. That justifies paying a premium for the Carlisle product.
Precisely.
Yeah.
The value proposition is instantaneous. And another fantastic example is their move toward supersizing components. They introduced larger 12-foot insole-based flat polyiso panels.
Instead of the old 8-foot ones.
Exactly. Traditionally, the industry standard was 8-foot panels. By increasing the panel size by 50%, trials netted a documented 34% labor savings for contractors.
Why?
Because you handle fewer pieces, you cut fewer pieces, and you have fewer seams to seal or weld, which significantly reduces installation time and the risk of error.
That's fascinating. It's such a simple change, just making a product bigger, but it fundamentally optimizes the workflow on the construction site.
It demonstrates a deep understanding of their customers' pain points. Similarly, the flexible fast adhesive dual tank system is another example focused squarely on improving labor efficiency and minimizing waste. This whole suite of innovations is their long-term moat.
It's the whole strategy.
It is. If they succeed in having 25% of their revenue come from products that offer 30% plus labor savings, they will have redefined their position in the market.
Okay, that covers organic innovation. Now, how are they using M&A to accelerate this pure play strategy? Are the recent bolt-on acquisitions, MTL, PFB, Thermofoam, are they just about adding new revenue, or are they structured to create immediate financial self-help?
They are absolutely structured for immediate financial self-help. The disciplined M&A playbook uses these bolt-on acquisitions to stitch together a comprehensive building envelope solution and, crucially, to create immediate hard cost savings through vertical integration and synergy realization.
And what's the target for that?
The total anticipated annual synergies from MTL, PFB, and Thermofoam acquisitions are expected to exceed $34 million. That's a massive amount of internal leverage they can pull.
Let's make that $34 million tangible. How does the PFB acquisition alone contribute to that goal?
The PFB acquisition, which deals in expanded polystyrene, or EPS insulation, provides a perfect case study in synergy.
Okay.
Before PFB, CSL was purchasing EPS resin externally. By acquiring PFB, they gained the capability to vertically integrate and insource EPS resin production.
Taking it in-house.
This move provides supply chain security. It reduces their Scope 3 emissions, which is a growing concern for institutional buyers, and is expected to generate over $10 million in annual synergies through that resin insourcing alone. So they aren't just buying sales, they're buying cost control and supply chain optimization, which is vital in this kind of high-cost environment.
This brings us to the most contentious part of the Q3 narrative.
Yeah.
Aggressive capital allocation strategy. We've established that operational headwinds led to a substantial organic earnings decline. So how on earth did CSL manage to report $5.61 EPS? This is where the financial engineering comes in, acting as the immediate firewall against market weakness.
It was more than a firewall. It was the entire foundation of their Q3 earnings per share. Let's focus intensely on the Q3 capital allocation mechanics, specifically the share buyback program.
Okay.
Carlisle raised its 2025 share buyback target to a staggering $1.3 billion. That's up from their earlier $1 billion target.
So they upped the ante.
They did. This demonstrates an unwavering commitment to shrinking the share count at almost any cost, seeing it as the most reliable path to hitting EPS targets in a soft environment.
Let's get mathematical here. We noted the overall decline in earnings. How much of that final $5.61 adjusted EPS was solely attributable to the reduction in the number of outstanding shares from these buybacks?
The direct mathematical impact was striking, and this is the core insight for our listener. The share buybacks executed in the quarter contributed a substantial $1.43 per share to the Q3 adjusted EPS.
Okay, 43 cents.
Now here is the crucial connection. The organic earnings decline. The one caused by volume deleverage and market softness. That was calculated at $42 per share.
Wait a minute. Are you saying that the benefit derived from financial engineering, the aggressive share buyback, precisely and substantially offset the operational decline?
I am.
The buyback contribution of $0.43 completely negated the organic decline of 42 cents.
Precisely. If they had not executed that specific amount of buyback, the reported EPS would have been flat or slightly down, reflecting the true organic pressure. The buyback acted as a precise mathematical bridge, ensuring that the headline EPS number remained robust despite the underlying operational struggle.
It's incredible.
It demonstrates that the current reported EPS is heavily subsidized by the shrinking share count.
That is remarkable, and it raises a critical question. Is CSL manufacturing its EPS right now?
What?
While it's financially sound, I mean, they have the cash flow after all. Relying on capital allocation to negate operational weakness is often perceived by the market as a sign that management lacks confidence in short-term organic growth.
It's absolutely a signal. It's a pragmatic bridge, but it is not a sustainable long-term growth engine. It's an effective way to maintain investor confidence and valuation during a challenging cycle.
But it's expensive.
It requires enormous capital. The question then becomes, how do they finance the $1.3 billion target without jeopardizing the balance sheet?
Given the size of the program, they must have leveraged up. How much debt did they issue and at what cost?
They leveraged their strong credit rating strategically. CSL issued $1.0 billion in unsecured senior notes on August 20, 2025.
$1 billion.
And this issuance was structured in two tranches, $500.0 million of 5.25% notes due 2035 and $500.0 million of 5.55% notes due 2040. So they are borrowing at elevated interest rates to buy back shares, essentially swapping future interest expense for current EPS accretion.
Issuing $1 billion in new debt at over 5% interest to fund a share buyback during an economic slowdown. Some investors might see that as reckless or a sign of desperation for EPS targets. How do we square that aggressive debt usage with their conservative financial identity?
We square it by looking at the resulting leverage ratio.
Okay.
Despite this major debt issuance, the company maintained a very healthy balance sheet. They ended Q3 with a 1.4x net debt to Adjusted EBITDA ratio.
That's very comfortable.
It's perfectly within their publicly stated target range of 1.0x to 2.0x. This demonstrates that CSL views debt capacity as a strategic tool to be deployed during cyclical weakness to enhance shareholder value, relying on that massive $1 billion operating cash flow to service the debt comfortably. They have significant balance sheet resilience.
And we can't ignore the signal of decades of discipline either. They also raised their quarterly dividend by 10% in Q3.
They did.
Marking their 49th consecutive annual increase. 49 years is an incredible track record. That means they have successfully raised the dividend through the 2008 financial crisis, the dot-com bubble, and high interest rate environments of the past. It speaks to a deeply ingrained culture of stable, reliable financial management.
That 49-year streak is the cultural anchor for the entire investment thesis. It confirms that the current debt issuance and share buyback strategy are driven by confidence in the long-term secular success of Vision 2030, not panic. They're funding a transitional period with the belief that the future cash flows generated by labor-saving innovation will more than pay for this aggressive use of capital.
We've dissected the segments, explored the strategy, quantified the financial engineering, and examined the capital structure. It's time for the final synthesis.
I would do it.
We have exceptional financial discipline and a clear path to future growth, fighting a clear, immediate market weakness. What is the final verdict on Carlisle Companies Incorporated?
Well, the investment thesis fundamentally hinges on your time horizon. The bull case is robust and it's clear. The $40 plus adjusted EPS and 25% ROIC Vision 2030 targets are absolutely achievable if the secular tailwinds materialize as planned.
And what are those again?
We are talking about the non-discretionary re-roofing cycle, mandated energy efficiency requirements driving demand for CSL's high-performance materials, and that persistent labor scarcity, which CSL's highly effective new labor-saving products directly address.
And the internal control mechanisms are already in place. The massive five-fold increase in R&D investment to secure future pricing power and over $34 million in annual synergies from M&A. This is all financed by that impressive $1 billion projected operating cash flow for the year. This is a story of long-term value creation.
Exactly. The company is structurally transforming into a high-margin, innovative entity, and they are utilizing their immense balance sheet strength to build the necessary bridge across this cyclical valley.
Okay, but the risk case.
The risk case is equally tangible and must be respected. The core danger remains that the persistent volume deleverage and the ongoing organic revenue decline, which drove a 2.1% contraction in Q3, will continue to erode margins faster and longer than the $1.3 billion in share shrinkage from buybacks can compensate.
The Q3 data prove that capital allocation was necessary merely to keep EPS flat. If that organic decline accelerates to 4% or 5% due to protracted high interest rates, the buyback bridge may not be large enough.
Or they may have to issue even more debt at higher rates, potentially stretching that 1.4x leverage ratio closer to the 2.0x ceiling.
Which would be a problem.
The revised guidance reinforces this concern. The shift to flat full-year revenue guidance and the deeper-than-expected full-year margin compression, now projected at a 250 basis point decline for the full year, that signals that the construction market is struggling severely. It is struggling to absorb the necessary price increases CSL needs to fuel the aggressive R&D and acquisition growth required for those future $40 EPS Vision 2030 targets.
So the final verdict suggests that CSL is a premium, strategically positioned company relying on its superior balance sheet and aggressive capital deployment to manage through a weak volume environment. The long-term thesis is sound because the company addresses secular growth trends, but the short-term reality is that investors are betting on financial engineering bridging the gap until the construction cycle rebounds and the Vision 2030 innovations generate self-sustaining organic growth. It is a calculated bet on management's ability to execute a perfect multi-year pivot.
It is a high-conviction bet on future structure winning out over current cycle.
Risk defined, portfolio protected.